fourth largest accountancy practice in Ireland by client numbers, and about 8th largest in terms of turnover. About 25,000 clients. So we're specialised in the farm sector and farm taxation. So we come across the issues in relation to forestry on a daily basis. So we feel we're experts in the field. Now, I suppose what I'm hoping that you get out of today is a few key takeaways. Everyone is going to say, keep moving this way, everyone is aware that forestry is very tax efficient, it's free of income tax, but there are a number of potential tax pitfalls to watch out for, and a few areas that you can just make things a little bit more tax efficient for yourselves. So I'm going to cover a bit on income tax, then I'm going to cover succession as well. Succession is very important in terms of tax savings when it comes to forestry. And there's a few little tips I'll give you in terms of that. And so we're going to look at capital gains, stamp duty, capital acquisitions tax. We'll talk a bit on VAT as well. And look, we'll have questions I think at the end of the session. So in terms of income tax, just to start off. So basically, as I said already, forestry income, be it clear felon or the premiums from forestry from the Department of Agriculture, are free of income tax. Now that's on the basis that it's occupation of woodlands. The woodlands have to be managed on a commercial basis. So what does that mean? It's what you're going to be doing already. You're going to be tinning. You have to do your tinning, look after the profit, look after the forestry, and manage it with a view to profit. Look, we should all be doing that anyway. Forestry that isn't looked after isn't tax exempt, so that's important to know. And it has to be included on your annual tax return. And there's reasons for that, and we'll talk about them in a minute. The next one I have here is the whole area of Christmas trees, because that was a bit of debate at the stage whether they were tax exempt or not. They are tax exempt in Ireland. The UK position is slightly different. They view trees, Christmas trees, as nursery, which is not the production of timber, and it's not tax exempt over there. So, but as things stand in Ireland, Christmas trees are tax exempt and free of income tax. So the next one, I suppose a lot of people probably will be aware of this, but forestry income is liable for PRSI and universal social charge. Okay, so it's not true to say that forestry income is totally free of tax. So it's not. So potentially PRSI is 4%. If your income is more than 100,000, you've up to 11% PRSI as a self-employed person. So potentially you could have up to 15% taxes on forestry income. Depending on the level of income, it could vary. Depending on the level of USC, could vary from anywhere from 8.5% up to 15%. So that's to bear in mind. What can we do to mitigate that exposure? One of the things is if you can replant in the same year, and that's not always easy because, depending on when the trees are taken out, but if you can replant within the same calendar year, and it has to be the same calendar year, then you can offset that cost against the universal social charge. So if for every 100,000 we can save 1,200 or more, depending on the level of USC, it's worth doing. The other thing sometimes people would do is clear fell over 2 years, and that way they're not hitting as high a level of USC in terms of the bands. Because the bands go at 8% over 70,000 of income up to 11% over 100,000. So, and lower down, looking at 4.5% income or universal social charge. The other thing, cost of tinnings is allowed as a cost against the universal social charge, as is the likes of insurance, or if we're doing fencing or roadways or anything like that, that can mitigate the tax costs there. Next area I'm going to gloss over, it's relevant contracts tax. It won't apply to most people because it really only applies to the forester. It won't apply to the farmer. But for someone that's involved in forestry operations, they're liable, they're in under what we call the relevant contracts tax system. So if they're paying a subcontractor, they have to either pay 0, 20 or 35% tax before they actually make the payment to the subcontractor. I'm going to move on then. Just look, I'm conscious of time. We're kind of going to speed through this in terms of it. Succession taxes then is a very important one in terms of the thing as well, or even if you're selling forestry or selling timber. First one there is capital gains tax. So the sale of the actual timber is tax exempt. Okay, so that's a big one in terms of it. But we have to be aware of compensation cases. So say you were to take out trees for forestry lines or maybe there's wind turbines going in or a solar farm and you're taking out those trees. There is a tax appeal commission case in 2017 where the tax appeal commissioner upheld that income was not tax exempt. And the reason that they came up with was that there was no disposal of the underlying land. So it didn't come in for the capital gains tax exemption. So just be careful there in terms of anyone that does get compensation in relation to trees. You need to be careful on it. It could potentially be taxable. If we sell land and trees together, the trees themselves are tax exempt and the land is taxable. You won't get retirement relief. I don't know, some of you are familiar with retirement relief in terms of transfer of land or sale of lands. You won't get that relief for forestry land. But in most cases, capital gains tax isn't an issue in terms of sale of forestry land because usually the value of a forest, once it's clear felled, has the underlying land has a low enough value because it has to be replanted. Okay, so it may not have increased in cost from the time you originally required it versus when you were selling it. So you may not have to worry on that, but it's one that needs to be looked at. It's on a case-by-case basis. Stamp duty, this is one that can cause problems. A lot of people mightn't be aware of it. Trees obviously aren't liable for stamp duty, and if you're selling land with trees on it, the trees themselves aren't liable for stamp duty. So you have to break out your valuation between trees and the underlying land. So say you sell a forestry land and it's valued at 400,000. The trees, if they're near mature, could be worth 300,000 and the underlying land is worth 100,000. So you're only paying stamp duty on the underlying land of 100,000. You're not paying it on the tree value. So it's very important to split out the value there. You'll be trying to keep the value of the trees up and possibly the land down. And there's a stamp duty saving there because at the end of the day, forestry land is liable at 7.5% stamp duty. So it's not insignificant. Usually where there's a sale, it'll suit the purchaser, you just see it there. It'll suit the purchaser as well to keep the value of the trees down because they're the one that's paying the stamp duty. It'll suit the seller because the trees themselves are tax exempt. So both people will be trying to aim for the same net result in most cases there, that the value of the underlying land is kept down and the value of the trees are kept up. There's an important 75% rule there as well on it. So to get the stamp duty exemption on the timber, more than 75% of the land that you're selling has to be covered in timber. Okay? So that's a very important one. It's important in terms of transfers of land to successors too, because if you transfer your whole farm, then 75% of the whole farm isn't covered in trees, then you're losing even for a young trained farmer, you're potentially losing the young trained farmer stamp duty relief. So now it's a complicated area, maybe losing you on it, but it's one to be careful on the whole area of stamp duty in terms of whether you're selling land or whether you're transferring it to the next generation. Usually what we end up doing is the forestry land is stripped out onto a separate folio, and that's transferred under a separate deed of transfer to the rest of the land. There's two transfers happening. In terms of the gift tax side of things then, say you're transferring the forest to son or daughter or to your successor, whoever that is. Trees, I don't know, are you familiar with the whole concept of agricultural relief? I might take it back a step. Every child has a threshold from their parents of 335,000, so that's income that they can take from their, or inheritance that they can take from their parents tax-free. Once you go over 335,000, 33% tax applies. There is a relief called agricultural relief. If 80% of the person, your successor's assets are farming assets, when they get the forestry land, then there's a 90% reduction in terms of the value of what they're getting. So that's vitally important. So someone getting forestry land worth, say there's a lot of forestry land in it, it's worth 930,000. If they've no reliefs, then there's 600,000 over threshold, there's 200,000 potentially in tax. If you can get agricultural relief, that 900,000 reduces to 90,000, you're way under the 335 threshold, you have no tax. So agricultural relief is important in a lot of cases in terms of passing on property. So the important thing to know with forestry land is different to other agricultural property is that for the three elements you don't have to pass the asset test. So, understand that? So, the trees themselves can pass without the asset test, but you are subject to the active farmer test on them. So, and again, if the forestry is managed on a commercial basis for 6 years after the transfer, we're okay. So, look, as I said, trees with a market value of 1 million, their taxable value is 100,000. And again, we don't have to worry about the asset test. So someone with a lot of investments or property can take $1 million worth of trees, that reduces down to 100,000, they have a threshold of 335 from their parents, no tax on it, still have 235,000 of threshold left, so it is very tax efficient. For the asset test though, for the underlying land, we do have to pass the asset test, okay, just be aware of that. But again, the underlying value of the land may be low, in a lot of cases, with a bit of tax planning, it is possible to get agricultural relief. If we can't, there is another relief called business relief, and that works in the exact same way as agricultural relief, and that is a 90% reduction. Only difference, the same rules. You'll have to hold on to the forestry for 6 years after the successor gets it, and it'll have to be managed on a commercial basis. I'm going to move on to that and conscious of time. Forestry is deemed to be a farming activity. So anyone that has a forest, they come in as an unregistered farmer. They mightn't consider themselves a farmer, but they are in the eyes of revenue. So they will qualify for what they call a 4.8% flat rate top-up when they go to sell or clear fell their forestry. So it applies to normal farming activity. And what is that? A normal farmer is someone, I suppose, that's not liable to register for VAT. Someone that doesn't have a trade that has turnover of more than 37,500. And if you are in that category, it could be that with a partnership with a spouse or another individual, that say you had a pub or a shop or something that's VAT registered, that could be kept under a separate tax number and you stay VAT unregistered on the forestry. And it is important to stay VAT registered on the forestry in most cases, because otherwise when we go to sell the timber, we're going to suffer 23% VAT on it. Which is very significant. So look, what costs can we claim back? You're probably some of you familiar from the farm side of things in terms of the VAT 58. Forestry is no different. If you put in a new roadway, fencing, all those costs you can claim the VAT back on. Okay, so that's there for everyone as an unregistered farmer. Again, it has to be new roadways and new fencing. If you put in repairs to roadways, repairs to fencing, you won't get the VAT back on it. Okay, so it has to be new. It's similar to the farm situation. It has to be something new. And the invoice must be in the name of the farmer. So sometimes you might have forestry under one spouse's name and the invoice is coming in the other's name. That won't work for VAT with revenue. You're going to have to get that invoice redone. But you will be able to get the VAT on it once the right name is on it. A very important one, and probably the most important tip I can give you today, if you can bear with me, I nearly finished on it, is when you're selling forestry, it's important that you decide, look, I'm selling this plus VAT. So if we agree 100,000, if that's the sales price, you're saying it's 100,000 plus VAT. As you can see in that example, if you agree 100 plus VAT, you're going to get 104,800. And you can see the cost of the merchant is only 100,000. Now, if you agree 100,000 including VAT, you're going to get 100,000. Cost of merchant is only 95,420. So he's taking your, or she is taking your 4,580 in VAT. So you agree it, whatever figure it is, you agree that figure plus VAT, and you should be getting that 4.8% VAT, not whoever you're dealing with. So it's important in terms of that it's clearly agreed with the merchant before you strike the deal. So if you are a VAT registered farmer, and look, probably not that many people in that category, but again, as I said earlier, 23% VAT on timber sales. If you're selling firewood, it's 13.5%. And if you decide to sell your forest with standing timber on it, you're paying 23% as well. So that's it really, folks. Let's say we'll take questions at the end. Thank you.